Uh, okay, let's start. So our first session is overview of corporate tax. A disclaimer, I have to say to everybody that our session today is really an overview. Okay, it's not comprehensive. What I would do my best is to cover substantial part of the corporate tax that is very significant in your business. Now, with my understanding what kind of business that you have. Okay? So I'll try to avoid the complicated ones which I feel is not relevant in your business. I'll do that. Okay? And then if you feel I'm still not covering enough, just ask the questions towards the forum. And hopefully we'll be able to cover that as well. So the session is overview, and therefore, again, not everything will be covered. I have intentionally made it to that so that I should be able to cover again the substantial part. Okay, let's start with the overview. So, what is corporate tax? Okay? So, it is a direct tax to a particular piece information, and that is our income or profit. Okay? Now, we have to make a distinction as to the tax is calculated against the revenue and the tax calculated against the income or profit. The corporate tax is calculated against company or business profits, not against the revenue. The tax that is being calculated against the revenue is what we have now, the VAT. So it's the direct tax on the revenue. That's the VAT. Corporate tax is the tax directly calculated against the profit. So that's why at the beginning, very basic, you do not need to confuse yourself at what number in your financial information you would base your corporate tax calculation. Okay? So I know some of us here, business owner, are not really accountants, so I'll do my best to try to bring down the level of discussion so that everybody can grasp at least the basics. Next. While we call it here as corporate tax, in other jurisdictions, we call it business tax. Okay? Even in the Philippines, we call it business tax. Now, this is different from individual income tax. Okay, make the distinction. The individual income tax is taxes directly against the income of the individual, regardless of business or non-business. But for business taxes or corporate tax, it is always 100% related to the business. Okay? Continue. Next. Okay, basic. Why is UAE finally introducing corporate tax? So there are 4 basic principles. So I'm jumping now. So sorry. So corporate tax introduced in the UAE. Okay, that's correct. So number 1 is complying international norms and best practice. For a long period of time, UAE has been a tax haven. However, it created some issues with other jurisdictions that have taxes. So they are trying to align themselves to at least introduce the minimum tax, the global minimum tax. Okay? So everybody is introducing a minimum tax. UAE is going to do that as well for business. Now, we will see later, even if UAE is doing that, it still has its advantage compared to other tax jurisdictions. Second, that would bring UAE to another level of economic position in terms of investment, in terms of economic opportunities. Because by introducing tax, okay, somehow it invites, especially introducing a very low income tax if you notice, the 9% we introduced here is very low compared to other jurisdictions, which range from 25, 30, 35, 40, 42%. And having a with a tax introduced in the business at 9% provides global economic advantage for this country. Number 3, accelerate development and transformation. Obviously, before taxation, UAE has been dependent on oil, right? So now they're looking for additional way of making money, right? Hence this taxation. Next. Like I said, UAE is joining the bandwagon of providing minimum taxation. Okay, I'll go to the 4 key principles. First, flexibility, alignment. Flexibility and alignment means the UAE is trying to align its country to the already well-established global powerhouse in terms of economy and scale. So, of course, UAE is already popular, but there are certain missing elements to be really being a very competitive country. And that is by introducing minimum taxation. Certainty and simplicity. When they implement the corporate tax, the FTA or the UAE government ensures that, yes, we will have corporate tax. It must be implemented very simply and very clearly, not complicated. Okay? And true, having started UAE corporate tax, it is easy to understand UAE corporate tax compared when I studied Philippine tax. Honestly, it is so challenging, so many exceptions to the exception to go back to the general rule. Here, it's different. Very simple, straightforward, very clear. Neutrality and equity. When taxation is being implemented in UAE, the government is ensuring that if we are going to tax a certain sector or a certain type of industry or a certain group of people, we have to make sure that the rate must be consistent and uniform to everybody, regardless of your status as a business, whether you're a small or a big business. Okay? And then finally, transparency. So FTA and the government made an effort that all our tax laws must be clearly presented and simply presented to everyone. And to do that, they have provided a lot of clarifications, okay, clarifications to the tax laws and regulations so that more people would be able to understand. They are also holding separate workshops to ensure people will be able to understand, okay, the corporate tax. Next. So now, sources. Now, if we are going to implement corporate tax in our company, the very first thing we need to understand is what is the basis of our compliance of this taxation. Where do we see the instruction? Where do we get the instruction? Okay? Obviously, number one, the very first instruction that we will get our compliance with is from the law itself, which is law number 47 of 2022, or the corporate tax, taxation for corporations and businesses. So, that is our number one Bible. However, unfortunately, this law is incomplete. Okay? If you had a chance to study this, there are certain provisions in the law that are still incomplete. And they would say, depends on the additional decision of the cabinets. Okay? Now, if a certain provision of the tax law is not very clearly explained in the law itself, because the law is, it's broad and general. The specific will come to the next sources. The first next sources after the law is the cabinet and ministerial finance decision. So there will be a lot of clarification that will come from the cabinet decision. That's why when you're reading the news, you will see a new cabinet decision has been released, okay, to guide, for example, on proper registration of corporate tax, okay, or defining who are exempted persons, okay, or the cabinet decisions as to what is the content of the corporate tax return. So these are items that you cannot see in the law because they are too detailed, but they are well explained in the cabinet decision. Next, FDA decisions. FDA decisions, these are decisions made by the FDA out of an issue. So someone might have an issue on complying or questions that requires opinion, and the FDA will issue a decision. Again, supporting the law, supporting the cabinet decision, and then this one is more specific because it covers very specific issues of a tax concerns. Number 5 is what we call FDA guidelines. Okay? So, now, in the guidelines, after issuing the cabinet, after issuing the law, guidelines will come in, and the guidelines will provide examples. So if you are trying to learn certain specific provision of the law of corporate tax, you have to find the specific FDA guidelines for that. The latest FDA guidelines that has been released is the corporate tax return guidelines. Okay? So what is the guidelines? It will give you a clear picture of the specifics. So like in the example I'm saying, the tax return, it gives you the specific questions being asked in the return and how you answer those questions. So these are guidelines. And then finally, what we call public clarifications. Public clarifications are again a specific part of the corporate tax law where FDA attempts to give additional detailed example and solutions on how you apply the law. Imagine all this, all the effort that we have done to ensure transparency. Do we get this in the Philippines? I'm sorry, not enough. Okay? So here, we're getting the guidelines, the public clarification as a layman instruction on complying corporate tax. So, in a nutshell, when we are going to prepare ourselves for corporate tax and wanting to study, okay, the tax law itself, do not limit yourself on the law only. You have to find also these other things, particularly number 5 and number 6, because this is where the actual details on how you will answer your issues on corporate tax, it will be there. So, if your company, who among you started collecting PDFs from FDA? Unfortunately, this is not new for me. There's a lot of companies even today does not have a PDF of Law 47. Okay? Now later, in our compliance strategy, this is part of the alignment that we will recommend. Okay? So we'll cover that. Okay, next. Next time. Okay. So how is corporate tax imposed in our business? Okay, now, again, these are basic, no? So first is, we need to register. Okay, and I think you've done that already. Number 2, the corporate tax rate is calculated in taxable profit. Again, so I was clarifying this already initially. It's not on the revenue, but on the taxable profit. How about, do we have taxable losses? What do you think? If we have taxable profit, do we have taxable losses? Actually, no. Because corporate tax is only levied when you have profits. Diba? Okay?
Yes.
Now, so we know that already. Corporate tax is done once a year. Once a year. Okay? Now, how is this different in the Philippines? In the Philippines, we do this 4 times. Quarterly. Okay? In UAE, once a year. Very beautiful. Right? Do you agree? Yes. Okay? And that would be 9 months from your closing of the tax period. Most of your tax period would be December 31, and therefore you start counting the 9 months from January 1. Okay? So therefore, September. Next. Corporate tax is all done and initiated by the taxable person, your company. Okay? Self-assessed, meaning the FTA will not calculate for you. No, you will calculate and make your own assessment how much you owe taxes to the government. And it's up to you whether you are going to be honest or not. Right? You can be honest, good. You can be dishonest, I don't know. But will FTA capture you? If you are dishonest or not? The FTA will have to work harder to find out whether you are dishonest. Okay? Of course, here, because we are in a seminar, obviously I would say, be honest. Okay? Next. When you are calculating corporate tax against your taxable profit, this means that you need to know how to calculate taxable profits properly. And the very basic thing to do this is you must have followed a certain accounting standard that the FTA allows you to do in calculating taxable profit. Question, can you just calculate your own taxable profit? And then from there, you calculate the 9% against it? On your own will? The answer is no. You have to follow accounting standard to bring you to the value of taxable profit. So what are these accounting standards? Okay? Actually, there are 3 standards. Sorry, I missed the third one. Okay? The first one is full IFRS. If your revenue as a company is more than 50 million in 1 year, you are mandatorily need to calculate or do your profit and loss following the full IFRS standard. Ano yung IFRS? What is IFRS? International Financial Reporting Standards. Okay? Only if you have 15 million dirhams of revenue. Okay. What about for businesses that has below 50 million but minimum 3 million? What standard will they follow? You have two options. Full IFRS, if you really want to do full IFRS, or IFRS for SME. Okay? Now what is the third one? For companies with revenue below 3 million, you have a third option. Cash basis accounting. Okay? Now, so far, in this part, it's very technical. So now we realize that when we're calculating taxable profit, it must follow a certain accounting standard. Question: is your company prepared to follow an accounting standard to calculate taxable profit? Okay? That question must be answered in part of your alignment strategy later. Okay? Next. So tax rate. Okay? Again, we're still in basics. Tax rate. In corporate tax, take note, there are only two types of corporate tax regime. Two. Not three, not four, not one, but two. The first corporate tax regime is what we call the standard corporate tax regime of 0 and 9%. Okay, this is the first regime. And all of you most probably belong to this regime. Okay? Most of us will be in this regime. What is the second corporate tax regime? It's called qualified free zone tax regime, where you have 0% corporate tax. Okay? That's why I asked earlier whether some of you are free zone, because maybe you will fall into this regime. But again, it does not mean that you are a free zone company. You are automatically belonging to the second tax regime. No. Most probably, upon hearing your industry, even if you're free zone, you will still belong on the first regime. So I'll start first with the standard tax regime. So you have any taxable profit not less than 375,000. If you calculate your tax profit and then you have less than 375,000, the tax rate is 0%. Anything in excess of that will be now calculated for the 9%. So this is an example. If your net profit is 1 million, the first 375,000 is 0%. Any excess to that, which is the 625,000, this is where you calculate the 9%. Guys, this is where the basic calculation of your corporate tax looks like. Okay? It will be simple as it is in the presentation. But there's a lot of things you need to do. Number one, how to arrive the net profit. Okay? Next. So the second regime is the qualified free zone tax regime. So this is only for qualified free zone. Okay? That's why I said earlier, it doesn't mean that you are located in a free zone or you are a registered free zone company, you are automatically covered to this regime. No. You must be, quote-unquote, the word qualified free zone company. We will discuss later how do we know that your free zone is a qualified free zone company. Next. So, if you are in this regime, all qualifying income will be 0%. The non-qualifying income will be 9%. Now, the difference of this from the standard corporate tax regime is that there is no more 375,000 threshold. Okay? So if you have non-qualifying income of 50,000 profit, automatically the 9% is calculated against that. Okay? So that's the difference. Later we will cover also which regime is more favorable on the second session. Okay, now, so Anjanette, let's take this one by one, okay? This presentation. So, how How do we calculate corporate tax? Again, this is basic, no? And this is just for illustration purposes. But before I proceed, did any one of you have read the guidelines for the corporate tax return? No, I assume wala pa, no? So, did you know that in the guidelines of the corporate tax regime, which basically contains the contents of our corporate tax return. In the Philippines, we call it ITR. Okay? So imagine the ITR of the Philippines. It's only one page back to back, right? Maybe we'll say there will be less than 100 questions in that ITR.